because the negotiating window for any of these mergers and acquisitions transactions starts as soon as that first offer hits the table. This is going to typically be the one opportunity for entrepreneurs that have a business to have a material wealth event. And if you want to get the best outcome possible, you need to get... There's a small number of people in New Zealand that do the work that we do. And I joke that our biggest competitor is actually that DIY.
It's the founder.
It's the founder, the DIY mindset.
And so, the biggest potential transaction of your life is this transaction. Don't f*** it up.
There is always a stage in mergers and acquisitions transactions, even the successful ones, where it looks like everything is falling apart. We were in this room, it was me plus the three founders and the advisor on the other side, and the three founders just got up and went, nah, over. We're signed to, what? You can't. And they stormed out. There is a famous saying sort of in the investment banking one, which is you set the price, I'll set the terms, and you always want to be on the terms side of that. If entrepreneurs could take one thing away, it's if that...
Today on the show, we have Mark Clare of Clare Capital. It's a fascinating conversation as we delve into some inside tricks and tactics that he's picked up from doing hundreds of deals across M&A in New Zealand, internationally, with big experienced M&A teams, particularly with a focus on SaaS. Not a specialist, but a real deep understanding and knowledge of how those deals have evolved and played out over time. Stick around, it's a wonderful show, and you'll take away some things you can implement in your business tomorrow. And so, Mark, you've got a fascinating backstory which we're going to explore today. I really thank you for coming on the show.
No, looking forward to it. Looking forward to the conversation.
Excellent. I'm going to drop a bit of a quote to you and then kind of unpack how this relates to what you get up to. It ain't what you know that gets you into trouble. It's what you know for sure that just ain't so. It's a quote from Mark Twain. I really love it because it posits that people have this perception of the world and a series of rules and structures that they go around with. And so as that relates to M&A, the things, the common wisdom in your experience that's actually incorrect, what is that thing?
Yeah, look, it's a fantastic quote. I'm a guy that loves my quotes as well, so I'm sure we'll try and throw a few of those in today. Probably the mergers and acquisitions version of that, and it's common knowledge. Everyone understands that if you want to get a high quality outcome in a exit process or a mergers and acquisitions transaction, you want competitive tension, meaning you want multiple parties coming in to bid for a company. And that is absolutely correct. But if there was one thing we would try and get all New Zealand entrepreneurs that are going through an exit process to properly understand is what competitive tension actually means. And the common thing we see, the very common issue we see happening with New Zealand entrepreneurs is they will receive an approach from typically a strategic or financial party wanting to buy their business, and they understand that they want competitive tension, but they just can't bring themselves. They want to engage with the one party for a longer period of time, and they actually cut their ability to have that competitive tension out because the negotiating window for any of these mergers and acquisitions transactions starts as soon as that first offer hits the table. And to a large extent, if you wait and sort of go, well, I want to play this out with a party and then go, oh, but I want to bring competitive tension in, you've missed that window to be able to do it. So it's partly that element of, people know and understand that, yes, I want multiple parties in the process, but they don't understand how quickly they need to move and what they need to do with some of those pieces. And if there was one thing that people took from this conversation around it, I'll probably stress it over and over again, that importance of bringing multiple parties to the table to get the highest value outcome.
You mentioned New Zealand specific, so why do you think that it is that it's a Kiwi thing to only have one party that you're entertaining? Is it a relationship thing or is it something different?
Look, I think there are some elements here, and one of the things that we've seen, particularly over the last sort of 10 years, as we've seen the New Zealand technology sector develop and become sort of the world-class industry that it is, traditionally we hadn't seen the number of international parties coming into New Zealand. So I think there was a certain element of the first generation of entrepreneurs were building things, and when somebody came in to talk to them about buying their business, they almost instantaneously went, okay, this is the one party that's going to be interested in my thing. I don't want to piss them off by doing something there, where in bigger markets it's better understood that if an offer comes in, your first obligation is to, can we bring more people to the table? Where it just feels here in New Zealand, there is almost, New Zealanders take it as a big compliment that somebody has often come to look to acquire their business, and frankly, they're almost sort of naively going, okay, this person's got my best interests in heart, where it's almost an element where, no, now's time to start playing that game out.
Yeah, that's really interesting. It's almost like a humility and a self-worth thing perhaps under the surface there.
Look, New Zealanders are getting much, much better at it. We've seen that happen over time, but we've had, frequently people will come to us and say, I received this offer 2 months ago. I've received this offer 2 months ago. I've been talking to this counterparty. It's getting down to the sharp end. I need your assistance to lift the price. What can I do to lift the price here? And there's almost an element of you've limited your options to do that because you needed to be doing that either before the first offer came in or absolutely immediately after. And I do think there's a humility component of New Zealanders on that, but again, we're starting to see the New Zealand companies and the entrepreneurs we deal with become more sophisticated and more ruthless on it, but there is still a distance to go compared to some of our American friends on some of those things.
Yeah. It's fascinating if you look back over the history of M&A in New Zealand software particularly. I recall Mail Marshall in the late 90s as being one of the first big exits that New Zealand had, 50-odd million, 55 million I think it was from recollection. And then we rolled into Navman, that was about 70-odd million a couple of 3 years later. Then we had a bit of a hiatus for a period of time, and then we had Mike Carden Sonar 6, was about kind of 26, 27 million, and then we did a rebuild back again post-GFC. And so it's been interesting to observe the trends because we've gone from these 20, we went from 50 to 70, back down to 20 to 50 to 70 to 100, and we've had a few $500 million and over $1 billion deal that's gone on. So what are you seeing in terms of the trends of M&A in New Zealand?
Look, that's a fantastic observation. There has always been tech in New Zealand, and as you talk about, there have been, and again, one of the great things is how do you define what a technology business is? How do you define what a technology mergers and acquisitions, transaction looks like? The way we describe it, and you broadly agree with the things that you're talking about there. We see the Trade Me sale to Fairfax in 2006 as in effect the big bang of New Zealand technology, with sort of almost capital markets and mergers and acquisitions activity. Prior to that, you are right, there have been small deals, and you're quoting some of the headline numbers there, but knowing some of the details behind some of those transactions, what the headline numbers were and how the transactions actually played out with earn-outs and other structures, they weren't often quite as big as the numbers that were being quoted. Now, what happened with Trade Me was, started in 99, by 2006, you have Fairfax coming in and buying it for $750 million. And that was the one that almost reset everything. Because even at that time, and again, depending on how you define how do you define some of those software ones? Even on the NZX, there were only 2 real software businesses listed on the NZX in 2006 when Trade Me was sold, which were both had market caps less than $10 million.
Yeah, wow.
And we sort of turn around and go, yes, tech was there, but Trade Me was that big bang which showed people what could happen. And you are right, we suddenly, Rod Drury had, been involved with, some of the transactions you're talking about and had been on the board of Trade Me, then started looking at SaaS and, in 2007 launches Xero. And again, you start to see, Xero then, go on that journey. And for the first time, we started seeing New Zealand entrepreneurs go, I'm not going to sell out almost at that early stage, but I'm going to go on that run to, the $20 billion plus valuation that Xero currently has. But we had the Xeros come through there. We had the push pays, launching in that sort of 2014 to 2016 period, and a number of those other ones sort of come through. But you are right. One of the things we have seen a lot of with New Zealand technology businesses is they get to a certain size and international acquirers do find them very attractive. We build world-class, product businesses here. We're not traditionally so good at the sales side of things there, but the quality of code and everything there, which Xero, TradeMe, and a range of, the push pays and that, a range of New Zealand businesses, we started to see the big US private equity and strategic parties start to come down and go, we can buy comparable companies to what we can buy in Silicon Valley or in Europe, but it's cheaper here in New Zealand. Yeah. And again, part of what we saw, which I think is not a bad thing for the New Zealand ecosystem, is some of those first-time entrepreneurs seeing those initial exits, but we're now starting to see the recycling of capital on some of the ones there. But we are definitely starting to see more and more bigger and bigger transactions starting to come through, which, look, it's a compliment to the industry. I had a famous, or in our world, a famous particular circumstance where we were talking to one of the 50 biggest software companies in the world. We were talking to them about a New Zealand company that was looking at this company as a potential acquirer of them, and we talked to their M&A team up in Silicon Valley, and we were on a call, and the big American company turned around to me and said, "Mark, can you hang on the call? Just want to give you a couple of pieces of feedback." And the team, and they're a big brand name, turned around and said, "We're not going to buy this company, but we are consistently seeing so much high-quality code and companies coming out of New Zealand. I don't know what you're doing down there, but we want you to show us everything that you are seeing there." So one of the things advisors like us, and again, it's one of the big questions that companies come to us and go, well, why should I use a New Zealand advisor? Surely I should be using someone in the US. We're talking to a lot of the US companies all the time, and they're going, you're the people on the ground that are seeing these, and the network and conversations that are happening now between New Zealand advisors and international parties is so much more deeper than it was, in those times you're talking about particularly over the last 10 years.
Yeah, I have a view on why that's the case, and I'll share the backstory, but I'm curious on yours contribution or challenging to that. So back in 2019, 2020, I was living in Australia, growing the Ambit, the AI platform company I was heading at that stage. And I was having dinner with Mike Cardam, so Sonar 6, Joyous, etc. You know Mike. And so great guy, good friend. And we were talking about, I was infiltrating the investment circles in Australia, both as an investor, but also looking to raise money for Ambit. And so one of the things that I continue to come across is a rhetoric, and there was a little bit of Aussies pissing in the Kiwis' pockets because we don't get a lot of that, and so we kind of like it a little bit. But they were saying how they really loved New Zealand companies, and this rhetoric was coming from Airtree and Blackbird at that stage as well, because we have this tiny little market. It's smaller than the Bay Area in San Francisco, 5 million people, and so very much the New Zealand mindset is that we need to be global from the very outset. And we've got a global from day one fund as just an example of that kind of approach. And so Mike and I, over a napkin and a few wines, kind of just listed out the number of unicorns that were in New Zealand at that stage, and we're into double figures. And Australia, I think, had 7 out of the tech sector. And so you can just imagine the frustration and the annoyance that was coming from all sectors of Australia for being beaten by New Zealand in that stage. And so the thing that I'm suggesting there is that one of the reasons these US M&A kind of organisations, listed whatever they might be or not, find New Zealand companies attractive is because of that. We need to be global from the very outset, and so they build with a international business in mind. Would you challenge that, or would you add anything to that?
No. Look, I would agree with that. One of the things, again, expanding on our element there of, Trade Me was the big bang. We did down in Wellington, I'm a proud Wellingtonian type thing around it, but, I used to, when I was doing presentations or talks in Wellington, invariably you'd be somewhere on the waterfront, and I would literally point out and go, "It's the northern end of Cuba Street up there, and you've got two unicorns that were founded on that corner over there in Wellington, being Zero and Trade Me." And we've seen more be played out there. And again, what you're talking about there of there was a window there, and I do have to give the Australians a huge amount of credit in that I think we were ahead of the Australians for a period of time there. And again, they're the lucky country; they had other areas around it. But to give the Australians credit, what I'm seeing coming out of Australia, the Australians have done a really good job of putting their processes and systems in place there. And I think both the Australian and New Zealand companies both are, the Australian market's bigger than us, but it's still pretty small. And I do think both the Australian and New Zealand companies have that, to give Chintaka and the team there and John and the team, they have that global from day one perspective. Because, and it's one of the questions we constantly ask people. And when people come and talk to us, we go, well, how big is the opportunity you're looking at? What's the total addressable market? Is it only Australia and New Zealand, or are we talking globally type thing? And the vast majority of New Zealanders do go, it's a global play, which is what we want to see.
Yeah, it needs to be. So interestingly, we're of a certain demographic to recall a period in history back in the 80s with the Olympics, and New Zealand won 8 gold medals at the 1984 LA Olympics, and Australia won, I think, 1 silver and 1 bronze, and they're incredibly just totally explosive with anger over this. They created the Institute of Sport as a consequence of that, and now they're just incredible and dominant across a whole range of different sports and segments. But I think there was a bit of annoyance at their little brother across the Tasman at doing that, and I kind of feel like there's something around tech with that to a degree as well.
I think that's actually a fantastic analogy. But more and more now, we are being, our focus is being drawn, and we're having conversations in Australia, and as I look at what they have built and the ecosystem they have put around it, I have massive respect for how the Australians have, realised the value and the size of opportunity for a country like Australia with tech, like we do here. And they've done a fantastic job with it.
Yeah, agreed. We were talking about creating tension and the importance of doing that. So imagine I'm a founder, because you talked about a situation where founders come to you after a couple of months of negotiating, from receiving perhaps a non-binding offer letter or maybe an expression of interest from someone. So imagine that I'm a founder and I approach you and I say, Mark, look, I've got this, people that are knocking on my door. They're talking about numbers with me. Help me. What do I do? What would be the playbook that we should go through there?
I do both work on what we call the sell side, which is when we're advising a company that's being acquired, but we also do work on the buy side. And for instance, at the moment, we're helping Meridian to buy New Zealand wind farms. So a non-tech deal, but we're working for the big company on this one around it. And the best way I can describe it as a professional, when I'm advising companies on the buy side, I never let them get into competitive processes. I work really hard to make it what we would call a bilateral negotiation, which is a one-on-one negotiation. But when I'm on the other side of selling, I don't let anybody get into a bilateral one-on-one negotiation. So here is what the playbook looks like. If somebody comes to a founder or a company saying, hey, I've got somebody knocking on the door, or I've received a non-binding indicative offer for my business, what should I do? Now, one of the things that we often see entrepreneurs will do is, well, they'll go, I'm worried that if I bring in an advisor, it will be seen as a negative by the company. You need to knock that stuff on the head. This is going to typically be the one opportunity for entrepreneurs that have a business to have a material wealth event. And if you want to get the best outcome possible, you need to get some assistance around it. And we'll talk about, I think we'll get to who are the parties that should be with you on the table there. One of the things, Lyd, is perhaps a misconception as well on some of the things around it is typically when a big company is looking to buy a small company, they actually want to see the company to be well advised, because if they don't, it can be random and unstructured and can sort of move on in a sort of chaotic way, which actually doesn't help. It doesn't help the company get the deal done who's looking to acquire, or on the other side. So what we would say, if you do not have a relationship already with a advisor in some way, you need to talk to people within your network to find out who is somebody that they think you could work with around this. Now, in a perfect world, we would have a long-term relationship with a company that is going through these things. But the reality of what we see in the market for sort of mergers and acquisitions advisors like ourselves, we are often brought in, like the offer has hit the table and somebody will then introduce us to the company, and the founder will bring us in and say, I've been told I need you, but I don't quite understand where that fits. And I constantly say, we will sign a letter of engagement where we become the advisor, but we don't actually become the trusted advisor until we've almost gone down a period of work where a founding team gets comfortable with us and the advice that we're able to provide. But what we would say on that is the optimal playbook there is, once the offer hits the table, is you go out and find an advisor to help you manage that offer. And typically what you will do, or the highest value thing that you can do at that stage, is to turn around and go, okay, we've got an offer. It may have a time limit on it. It may be an exploding offer where you've got to move quite quickly. What we would always say is, you should quickly come together with a list of the strategic parties that you are engaging with, who are not the party you've come to. You will typically work with an advisor and your own networks and say, who are the parties in our broad strategic setup there that would be a logical acquirer for it? Who would we want to sell the business to? And then get the advisor plus the company would bring some high-level information together and quickly go and have conversations with those strategic parties. And the wording is something like, we have received a serious inbound interest for the business. We have received an offer. We're taking it seriously. We've appointed an advisor to help us manage this. We're not under exclusivity at the moment. We deeply respect company XYZ, and within the industry, we respect what you do and how you do it. Would you like to have a conversation around the company at this stage? Now, people will sometimes go, no, we're good. Crazily enough, a lot of entrepreneurs go, this company knows a huge amount about us or what we do, and frequently we often discover that they don't. So often it is that element of getting it known that there is a credible offer in front of the company and talking to some of those strategic players around it. Now, we also, making the distinction, there are what we call financial investors and strategic investors. Yeah. So strategic investors are typically competitors and other players. They may be either direct competitors or adjacent players within the industry. They're the highest value parties to be talking to. They're the ones that can probably write the bigger check size around it. But here in New Zealand, we're also starting to see a lot of the financial acquirers be in there, and New Zealand entrepreneurs are seeing a lot more interest from those financial players, but the reality is the financial players won't be able to write down the same size of number that a strategic party can. So the focus should tend to be in that, who are the high quality strategic ones around it. And I'm not saying go out to 25, 30 people in there. You should identify who are the probably 4 to 7 companies that you think would be you would be interested in selling to, and go and find a way to have those conversations around it.
It's really helpful insight. One of the things that you mentioned that was perhaps a surprise to me was the reality that people on the buy side want to see a credible and capable advisor working with those on the sell side. So therefore it brings an element of professionalism and certainty and diligence to the transaction. A question that I wanted to double click on with you, Mark, is that back to the situation that I'm the entrepreneur.
Yeah, sure.
I have an offer in my hand, and one of the things that I've observed with most founders is that they tend to have some form of sales chops typically about them.
Yep.
And as we both know in the sales world, there's a idiom which is time kills deals. Time kills deals. And so I'm sitting here with this offer letter, and then I call Mark, and Mark says, we need to build some competitive tension. Totally understand. I get the notion that sits in behind that. And then in the back of my head, the voice would be going, time kills deals. You've got this offer letter in front of you. So how would you allay my concerns about that paradigm?
We went through a period of time advising a group of entrepreneurs where people would turn around and say, I've received this offer. I need some help to guide it. I'm going to manage the process myself. I just need you to sort of almost direct me and make sure I'm not doing anything wrong.
Hold my hand
type thing around it. When the reality of some of the elements there, when it got down to the hard and the difficult parts of the negotiation bit, those entrepreneurs ultimately end up going, I don't even want to be in the room. You go in there and go and do some of the stuff there and do that. So you are realistically, the fastest we've ever got an M&A deal completed was 8 weeks. And people go, that was record-breaking time on some of the stuff. You are more looking, you should expect that it's going to be a 4 to 6 plus month process. And yes, you want to deal with the counterparty respectfully and things like that, but you can buy yourself some time to have those conversations and that around it.
Yeah.
So yes, you don't want to lose momentum, but it's not a situation where somebody's going to if somebody's putting a credible, serious offer in front of you, they're not going to take it away 24 hours later. Or even if they have got, a timeline on it, and I've been working with a couple of transactions at the moment where the counterparty have put timelines on it, and we're responding to that in all of those circumstances, because again, we've come in, we're dealing with professionals, sophisticated people on the other side, we're working through, and invariably it's like, yes, we're moving these things forward, we're doing all the things there, but there is more flexibility on that time than entrepreneurs will typically think there is.
Yeah, got it. Okay. I hear you loud and clear. And so the subtext to that is that there's a DIY mentality that we still have in New Zealand. And so what you're saying to people is that this is a really meaningful, important transaction. You used the word, which I loved before, obligation. Yep. And you have an obligation to your shareholders to ensure that you achieve the maximum realised benefit for them and for yourself as well as a part of this. And so be diligent about getting the right advice on your side and making sure that you are doing things like defer time so you can bring some competitive tension to the table.
Absolutely. There's a small number of people in New Zealand that do the work that we do. And I joke that our biggest competitor is actually that DIY.
It's the founder.
It's the founder, the DIY mindset.
Yeah.
I constantly argue, or when we're sitting with people, go, you need to bring somebody in. If it's not us, that's fine. Go and find somebody you trust or you want to work with that you think can help you and guide you through this, but you would be crazy not to do that. We've got 2 circumstances where we had a relationship with the company, and in both of the circumstances they tried to do it themselves.
You were sell side?
We were sell side. The founders, again, high quality salespeople, know their industry really well, went out and tried to do it themselves. And it blew up, and they then came back and said, okay, we tried to do this, and we're like, yep, not quite got that right, and we got a couple of deals, both of those deals completed.
We rubbed around the team to have on your side. Yep. I'd like to unpack that a little bit more. You said M&A advisor and lawyer. So if I'm assembling a team, I'm the founder, what kind of folk and what experience should I be looking for as a part of building that team?
You need a mergers and acquisitions specialist as a lawyer. Now, a lot of people go, hey, I've got a commercial lawyer, I've got a guy that does my property work, I know a guy or I know a girl around some of the stuff and they're very good and I trust them. You will typically look for somebody that's got that specialisation in that mergers and acquisitions space. your team of advisors will typically be a commercial advisor, sort of investment banker, M&A specialist, which will help you through the commercial sides of things, and then there'll be the lawyers that'll help you to properly do the documentation.
Yeah.
We did a deal at the end of last year where a giant American company bought in New Zealand, a small New Zealand tech business. It's not public yet, so can't name names, but the American company rolled in, and it's sort of Fortune 50 sort of size company, and they said, we have to do the legal work around it, so we needed to have somebody that had that cross-border American sort of experience. And the funny part was they rolled out the Chicago law firm. There were more lawyers out of Chicago working on the deal than the New Zealand company had total staff.
Employees.
And total employees. And we got the complete American sort of sale and purchase agreement, which was all capital letters, all Times New Roman. Wow. And again, when it came through, the founder was like, oh my God, what are we dealing with? Who are these people? And again, luckily, it's we're getting that sophistication now where we had some lawyers in place to be able to deal with all of that type of thing, which is good.
Yeah. James McCarthy of Spider Tracks was on the show a few months ago, just before Christmas, and very bright guy, really great conversation. Yeah. And he raised this point from the vendor's side. He had been the founder and the CEO of the company. They'd brought in a professional CEO, and he'd gone off to get another startup out of the ground. And there was, through various fundraising rounds, there was a number of different shareholders, and it was quite tricky to navigate their way through the negotiation process. So he rightly decided to get back involved again. And what he realised about midway through the negotiation conversation with the potential acquiring party is that I need to do this deal, but these guys actually need to do this deal as well, because they're the M&A team.
Yeah.
And so an M&A team has to do M&A.
Yeah.
They're not incentivised by not doing M&A. Of course, they're not going to do a bad deal, but they're bringing a bunch of experience to the table. Yep. And so what I've heard you say loudly and clearly is that you need to bring people that know how that game is played and what the types of engagement processes are, the bits of conversation, the loopholes, the Americanisms that you might be dealing with. If there's any Europeanisms involved in there, none of those are bad things. They're just different from what it's like in New Zealand. And so, the biggest potential transaction of your life is this transaction. Don't fuck it up.
Yeah, basically.
Apologies for the interruption, and thanks for listening to the show. These shows take resources to build and put together. We have a team of producers, we have some promoters behind the scenes, and of course we have the guests that generously give their time to come on the show. My only ask of you is that you go and check out my website. I advise founders on how to build value and how to navigate the exit process successfully. We have a diagnostic on the website. There's an ebook that I've written. There's a free chapter of my upcoming book, Wantrepreneur, on there. So I'd just urge you to take a couple of minutes and go and check out joshcomrie.com.
I've been through hundreds and getting some of the ones there. There is always a stage in mergers and acquisitions transactions, even the successful ones, where it looks like everything is falling apart. And invariably there will be something which will bring things, off the rails. And it is of the deals that I have completed, there are a handful, 3 or 4, which were super smooth all the way through. Invariably, there is always a stage where things will look like they're about to fall apart. And again, that is a key part of that role. And again, we say we've seen this movie before. The movie's always slightly different, but there are elements through it. And again, an example of that, again, I think I probably can talk about it. We advised a business called MetOcean, which was a marine forecasting business, and that was bought by the Met Service, and name synergies, MetOcean and Met Service, and so the Met Service bought, this was 2013, 2014, and we'd negotiated everything had gone reasonably smoothly, and the 3 founders of the MetOcean business were scientists, and when we got to the final stages of the bit, the advisors on the Met Services side turned around and said, and I'll always remember this, turned around and said, okay, we are going to need to have a restraint of trade. And the three founders, we were in this room, and it was me plus the three founders and the advisor on the other side and some of the stuff. And the three founders just got up and went, nah, over. We're signed. What? You can't. And they stormed out.
This is a post-deal restraint of trade.
Yeah, post-deal restraint of trade. They wanted a thing where they couldn't set up a couldn't set up a competing business around it. And they stormed out, and I was just like every I had been dotted, and we were in a law firm's offices, and they headed out. I was just like, just a second, and I sort of went after them, and put them in a room, and they were like, Mark, I said, this is the standard thing they are asking. They don't want you to disappear off and to replicate the business around it. I said, it's not an unfair thing that they are asking, and. These three guys turned around and said, I'm sorry, Mark, appreciate everything you've done here around it, but we are scientists. You cannot stop us being scientists. We will not sign up to anything which takes us and stops us being scientists for any period of time. Right. And I'm like, guys, is your plan like they were honest, straight shooters. I said, are you planning to set up another business? They're like, hell no, we want to be here for a period of time, but we will not be, we're scientists, we will not be constrained. And I went, okay. And to give the CEO of the Met Service at the time credit, he'd called me up and said, Mark, if there's a problem, we need to find a way through here, tell me what it is. And I ended up going over the top of the deal team's head and called the CEO of Met Service and said, this is the situation. And he asked me, he said, are these guys trying to pull a fast one? I said, I really do not believe they are. But this is such a thing for them. And to give him credit, he came over his team and said, no restraint of trade because we want to get it done, which got the thing done. And the guy stayed at the business for more than 5 years doing some of the stuff there. They never said any, and again, worked with them for a period of time. But those... Even when you think you've got, everyone thinks it's going to come down to the, arguing over the dollars. Is there enough dollars?
Conditions.
Never.
Yeah, right. It's the terms.
It's the terms.
Yeah. Okay. Yeah.
And there's some of the things there around it.
Yeah. I think about there's an analogy which I've used before, and I'm bouncing this off you for your thoughts, which is that the DJ crossfader situation. And so on one side you've got a track A, and the other side you've got track B. And in this context, track A is money, and track B is terms. And so I view the slider that sits in the middle as being, you can have all the money in the world but the worst terms in the world, or you can have a decent amount of money and fair terms, or you can have not that much money and really, really generously walk away terms and no restraint of trade, et cetera, et cetera. I kind of view it as being, it's very difficult to have all of those things stacked in either side of your favour. If you're the buyer, you can't have everything in your way. If you're the seller, everything in your way. Is that a kind of a fair...
There is a famous saying sort of in the investment banking one, which is you set the price, I'll set the terms, and you always want to be on the term side of that. And you are right. There is, how do you balance those components off? Because people will, the terms tell you a lot about, what people are trying to achieve. I did a deal 15 years ago where we'd got to the final stage. There'd been a huge amount of negotiation around it, and we'd had a huge amount of argument about that, how long the retention people were going to stay on board, and there was some remuneration tied to that. And we were in the company's offices drinking champagne, and I watched one of the founders walk to his it was a PC at the time type thing, walked to his PC, and on his desktop he'd set up a 2-year countdown clock and just walked over with a glass of champagne in his hand and went, hit start. And I went, it's not a good sign type thing and that around it. And yes, like there is an element there. It's, we say it's hard to run away from your incentives. I'm trying to remember the name of the company, but it was a European gambling sports fantasy gambling site. And the company desperately wanted to be a unicorn. And so they turned around and went to all the funders and said, we want a $1 billion valuation around it. And they talked to a bunch of ones, and one of the funders turned around and said, yes, I will give you the $1 billion valuation, but I want a 3 times liquidation preference, meaning I get 3 times my money on the I get 3 times my money on the cash that I put in, and I want control over saying yes or no to any mergers and acquisitions transactions. Absolutely insane. But the guy said yes because he was desperate to be. He wanted to be the founder of a unicorn type thing around it. Paddy Power turned up, and it was a 150 odd million pound investment that was being put in at this $1 billion valuation. Paddy Power turned up and with a M&A offer at just under $500 million, 500 million pounds, and the investor went, "Yep, done." And with the 3 times liquidation preference, the founding group built a company, achieved a $500 million exit, and actually got nothing out of it.
Wow.
Because again, you set the price, I'll set the terms. It requires the work and aligning incentives for people to do that to ensure you get the optimal outcome there around it. So founders, absolutely need to be aware of what those terms are, be it capital raising or M&A on that.
In New Zealand, you may be most famous for the weekly newsletter that you produce. I've been consuming that for, I think, probably 5, maybe 6 years now. You're at least in the 300s in terms of numbers of issues.
We're over 350.
Over 350. And if you haven't read it or come across it and you've got an interest in SaaS and M&A in New Zealand, then go to Clare Capital, CLARE, capital.co.nz and sign up. It is a wonderful, wonderful piece of production every week. Your team put a lot of effort into it. Great infographics, all these cool things. Now, the reason that I bring that up is because that's kind of a SaaS-oriented thing. Now, we know that you're not just in SaaS, you do things outside of SaaS, but let's double-click on SaaS for a second.
Surely.
Tell me, what is the rule of 40?
The rule of 40 is how fast you add your revenue growth rate to your profitability.
So let's say you're growing at 10% per year.
Yep.
And then your profitability would be your percentage of EBIT as a proportion of revenue?
Yes.
Yep.
So,
cool.
and again, we'll talk about the components there around it. But the gist of it and the rule of 40 is you should be targeting those 2 numbers adding to 40%.
Got it.
So if you're growing really, really fast, if you're growing at 100% year on year, technically you could
qualify.
You could qualify, but if you're growing at 100% year on year, you're allowed to lose some money.
Right.
So you're allowed to. There's a cost of that. There's a cost of that growth, and people will give you some of that. So you could have up to a negative, 60% EBITDA margin. Okay. So it's all right to burn money if you are growing, but if you are not growing, if you're only growing, 5 or 10% year on year, you need to have a level of profitability which looks like 30 to 35% based on that level. Because what you are aiming for is, if you are achieving that rule of 40. It's a good metric to be chasing if you're running your company. But the key trade-off is you're allowed to lose money if you're growing. Now, one of the things which is fantastic on a bunch of how SaaS has developed over the last 10 years is we're getting a lot more sophisticated on how you go about which metrics are being chosen there. So,
because there's so many in SaaS.
There are so many.
CAC, ARPU, LTV. There's at least 15 that we could name between the two of us in less than a minute.
Totally.
Yeah.
But again, one of the things we are seeing with a whole lot of these metrics, and one of the things you will often see if you are in a mergers and acquisitions or a capital raising process as a company, either the funder or the acquirer will often want to actually start seeing some of your broad numbers, and they'll start to do some of their own metrics. And we've seen Rule of 40 be calculated a range of different ways. So one of the elements there, and people have made adjustments to it. So one of the things, again, within the SaaS bitlet is a key thing to understand is the unit economics of a business. So just as a gross margin, which is, simply calculated as your revenues less your cost to serve, that typically for a SaaS or a technology or for a proper software business is typically around 80%.
One of the great things about SaaS is that it's attracted some of the greatest minds in business or in the world over the last 20 years because the returns or the perception of the returns is that they're very high. And so the consequence of that is that you end up with really cool insights and analysis and metrics and things, but then of course they evolve so quickly. And so the Rule of 40 I think came about 3, 4, maybe 5 years ago, but of course that's going to change along the way. You mentioned a really important word, and I want to just pause on this for a second. You said consistently achieving. Jim Collins, who is of the Good to Great fame, who then went on, a lot of those companies failed because that text was researched in the late 90s and then the tech boom and wreck happened. And then he went on to write multiple other books. I believe his best work is one called Great by Choice. And he profiles companies, for those that are unfamiliar with his work, he profiles companies that have ostensibly come from the same industry, had the same opportunities, and they've grown at quite different rates and they've achieved at quite different kind of levels along the way. And so one of the things that he talks about is that the 20-mile march as being one of the most important things for a company. In other words, they grow consistently every year at 30, whatever percent, 50%. It's really hard to maintain 100% per year growth. So let's say they've grown kind of 6 years at 40 or 50% per year. That's that company will be more highly valued than one who grows 100% one year, 10% the next year. When you're going through the process of DD, of the M&A evaluation from the team on the buy side, how much do they value that consistency of profits, of growth, of customer success, etc.?
10 years ago, we would if we were positioning a company with a funder or an M&A counterparty, we would do the numbers, and show them and say, here are the calculations, here are the numbers. More and more, what people are asking for on those sides is they're like, give us the raw data. So intriguingly, one of the things there, and again, one of the key things that elements that we are seeing, which is a massive change, is IMs or information memorandums are still being produced. They're getting shorter, but we are seeing data packs, big data packs of anonymatized, quite raw data being put together because counterparties are going, I want to. Yes, you can tell me you can tell me those are your churn numbers, but with the greatest respect, Joss, I don't believe you. I want to check, and that's definitely something that's been a big change. But the answer to your question is absolutely. As Xero started to really ramp up in about 2013, 2014, when it suddenly started getting some real traction, Rod gave a fantastic presentation up here in Auckland, and I wasn't in the room, but a whole lot of my finance industry people that weren't working in tech were, and he described, and somebody was asking about the recurring revenue business model, and he turned around and he said the reality of the recurring revenue business model is I start the new month with last month's revenue already in the book, and I grow from there and on some of the stuff. When he did this, like seriously, there were 10 people in the thing. My phone blew up with all these finance people going, "This can't be right, can it?" On some of the things there. So you are right, and this is one of the things we've seen a number of times. And one of the things that's really good when we're working on that sell side is an ability to lay out the financial position and picture of a company in a proper SaaS way is absolutely vital, because if you get it wrong and people lose faith in the numbers that you are giving them, it is very, very hard to come back in either an M&A or a capital raising situation around it. Now, my team, we were really lucky. So we did a lot of work with our friends at Xero. So we built Xero's internal financial model going back to like 2014. We built Push Pays pre-IPO. We did a whole work for Plexure. The metrics work for the likes of Sequent. You've got to find one of the things in that SaaS bit is, yes, telling the story is incredibly vital, but you've got to be on top of your numbers. Yep. And if you're not on top of those numbers, it's going to cost you. And we've seen a number of situations from both the buy and the sell side where people have given us things, and if we lose faith in what people have given us, you're getting yourself in a hard place, because those numbers and those hard analysis will form a key part of the outcome that you're going to receive.
Yeah. It's probably back to the comment that you were making before, that many, many deals have the risk of looking like they're going to get derailed along the way, and that's probably one of those things that could have a big influence on it, potentially have that ultimate outcome as well, kind of shunting it off the tracks.
Yep.
You started to dwell on, and I'd really like to delve into this conversation, what is trending in terms of valuations of SaaS-oriented companies, New Zealand and globally, over the last few years. Contextually, we had a massive spike over COVID, 2021, 2022. I myself as an investor made some decisions that in hindsight I perhaps shouldn't have made, based upon some inflated valuations and some weirdness that we were all sitting at home and making decisions that we thought were fully calculated, but they were in a place of isolation and kind of everything else that was going on in the world. But that's the context. I'm curious as to what you're seeing around in valuations at the moment, Mark.
To quickly almost step back to what drives the SaaS multiple. So we sort of talk about 4 key components to that. So the first of which is that total addressable market. How big is the market that a company is playing within? Is it New Zealand? Is it New Zealand and Australia, or is it that big global one? We also talk about, it's important to understand whether it's a horizontal or a vertical play. And what we mean by that is, if you've got a project management software business and it's project management software across all industries, that's one thing. But if you've got a project management business which has every advertising agency on the planet utilizing it, that vertical play there is a lot more valuable than that horizontal one. So a big part of that first stage is understanding the market that people are playing in. Second part that drives those valuation components are the scale of revenues. And that's, we've talked about, one of the things we've talked about for a long period of time is, people will come to us and they'll say, okay, I've got this SaaS business. And we go, well, until you get to that $1 to $2 million worth of revenue, you haven't really got anything. You can fake. It's pretty easy to fake a level of revenue, but once you get to that, $1 to $2 million, and we would probably argue $1 million US of revenue is the table stakes. That's when we would say you get on the chessboard and you're starting to really play some of those sort of SaaS games. Once you get to that 5 million of ARR, you start to get of annualized recurring revenue, you start to get some real options. And when you hit that $10 million worth of annualized recurring revenue, you have some real international options for both capital and exit opportunities. So if you've got that big market, you've got a level of scale of revenue, that used to be enough. But now people are absolutely, as we talked about those sort of metrics, people are starting to look underneath the hood. They want to know, what are your gross margins? What is your, what do your cost to serve numbers look like? What do your CAC numbers, your cost to acquire numbers look like? What do your churn look like? Where is the profitability? And if you've got those, what we would call proper software unit economics, 80% gross margins, the server runs the business, you've got it, the business looks like a software business from a financial point of view, that's the key. You've got to tick that box as well. So if you've got that large total addressable market, ideally vertical, you've got a level of scale of revenues, and you've got proper software unit economics, you'll earn that revenue multiple, because most traditional businesses are valued on a multiple of earnings or profitability of EBITDA, typically. And we still see that with a bunch of the software firms, as certain software firms, but you will get a revenue multiple if you can tick those 3 boxes. What drives the size of that revenue multiple is how fast you're growing. And there is a big, typically a lot of people will come to us and go, I have a SaaS business, it's got these 3 things, that's worth a 10 times revenue multiple, is it? And you're like, how fast are you growing? And they'll go, we're only growing at sort of 20%. I'm like, you have not got a business that's worth a 10 times revenue multiple. Now, what we see is, if businesses are growing in a SaaS sense quite slowly, and what does that look like? That's probably below 25% year on year. you're only going to see a revenue multiple probably in the 1 to 3 times range around it for that type of business. And coming back to the rule of 40, what you're almost seeing there is you're seeing if you're growing that slowly, people will expect you to have a level of profitability, and you're being valued at a sort of 8 to 12 times EBITDA multiple around it. So in effect, you're being valued as a traditional business because you don't have that growth. Once you get above that 25% up to sort of the 75% range, but the sort of the less than the sort of 100% year-on-year growth, you'll start to see probably, you'll see that sort of 3 to 6 or 7 times, revenue multiples coming through. And it's not until you get some consistent showing some sort of hyper growth, which is that 75 to 100% plus year-on-year for a period of time, where you start to get those sort of 7 to 8 plus times numbers. Yeah. So that's what we're seeing in a lot of those multiples.
What does a strategic acquirer look like?
The strategic, at the most basic level, a strategic acquirer, as opposed to a financial acquirer, is a party that operates in the same industry or space that you are operating within.
So like a competitor or a vertical integration kind of player.
Totally.
Or, horizontal integration potentially as well.
Potentially.
Yeah. Okay.
One of the things within M&A, the highest value outcomes, we say the highest value outcomes happen when companies are bought, not sold. And that's when typically, and we've just had this one play out, which isn't in the public domain yet, but we hope will be soon, a very big brand name out of the US identified a gap in their offering, came down and bought a New Zealand company for it, and it drove a fantastic outcome for the company because the big American companies are, we've got to have it, and we're not getting into any sort of process. We're just gonna make that happen. Yep. But when you are, if you as a software entrepreneur, or you've got a business and you're looking, going, actually we've done a strategic review, we've determined we're not the highest value owner of the current shareholders aren't the highest value owner of the business, we want to go out and see if somebody else will acquire this business, if you want to run a structured sales process for it.
There's a rhetoric in New Zealand which is that Kiwi founders can sell too soon. They call it the 3Bs complex, the beat, the batch, the beamer, and the boat.
Yep.
In other words, when they've gotten to a certain level of wealth, those things are not as expensive as they once were in some cases, and in other cases much, much, much more expensive.
Yep.
So firstly, do you believe that is the case? And if yes, why?
There is a fourth one which people joke about, which is the blonde trophy wife type thing around it.
I'm going to jump in there and add something. One of my favourite Warren Buffett, I call them Buffettisms, expressions, is that he says that he said a lot of my mates are going up and getting what I hear to be called trophy wives. If you ask me, I call them the booby prize.
Yeah, I'll be careful what I say. I probably shouldn't even make the jokes on the various ones there. I don't worry about it, if I'm honest with you. I don't think it's a problem. I think we will start to see, I think it's part of the journey here for New Zealand. Like Rod Drury is a great example of somebody that had an exit. We talked about Aftermail. Had the exit, saw what happened with Trade Me from being on the board there around it, and then said, I need to do something bigger than this. And I don't think, if anything, he gets enough credit for what they created with Xero there around it. And I think we will see more of those. We are definitely seeing a recycling of capital. There's a big discussion around Wellington of, Wellington struggling at the moment. And yeah, there's a range of challenges there, but if we get a group of people driving it from the bottom up, I think that's the only way that it's going to happen. And I do think we're seeing more success and more recycling of expertise and capital starting to come through.
Yeah, I totally agree. Many of the folk that I've had on the show that have been through the founder journey said that they uttered the comment along the lines of, if I knew how hard it was going to be, I may not have done it. Yeah. And because it is bloody hard, it's brutal, especially if you're in the startup space. I define a startup as doing something that hasn't been done in a way before, creating a new market from the ground up. And so I think that I raise that rhetoric because we've both heard it quite a lot, but I think that it comes from those that haven't walked the path, because the path is brutal. And so if someone wants to take some risk off the table, if someone wants to have an exit event, if they want to take some time out, then that is a wonderful thing to do. I personally, and I'm curious on your thoughts on this, we're delving into a space that's not directly a part of this conversation, but it is the future of this industry, and we both care deeply about the SaaS industry and about the M&A space, is that the bigger concern that we face as a country is the number of young New Zealanders that are getting on the plane to go and live in fucking Sydney or fucking Melbourne and get what they believe to be a better quality of life over there because they've somehow been sold the rhetoric that the opportunities are not in New Zealand. And I agree with you completely. The ecosystem is now, we're 25 to 30 years on now from those really early exits. And those guys from the companies that we talked about at the outset of the conversation, they are still around, involved in the space as advisors, as investors, as board members. And so they're really kind of making sure that, once you've done it once, you can get a bit of a playbook, you can see how it's done. We've talked about that there is the Trade Me Mafia out of New Zealand, the PayPal Mafia out of the States. So there's people that have observed, participated in the journey, then they've gone off and done it themselves in their own businesses. We've seen that happen with Auckland and a number of different businesses as well. And so my personal concern is the amount of young New Zealanders, our future promising talent and hope, that are going, New Zealand is not the place for me because I perceive Australia to be better. So I'm a business reading geek, and for whatever reason at one stage I read a PhD thesis which was called The Age of Enterprise, and it was on the birth of entrepreneurship in New Zealand. And it basically said that New Zealand was essentially forged off the back of people that had this, that they were class oppressed. And so the largely UK citizens that moved out to New Zealand in the 1800s, and they were butchers, bakers, candlestick makers, and so they had some form of a trade. But because of the consequence of them being, working class, they were held back through the level of society that they were in. And so they came to New Zealand and then saw the opportunity to, assist in the forging of the country, got through the land wars, and then started to build these businesses. So entrepreneurialism is in our blood, literally. And so I'm pleased to see that there's young folk that are around that are thinking in this way and thinking opportunistically. We both know that entrepreneurship is not for everybody. No. And there is no shame in taking a job or having a side hustle and having a job somewhere. No. Entrepreneurship can be totally brutal. So we've walked a lot around this conversation of M&A, Mark, and it's been a wonderful chat. And I'm just coming up to my closing question. But before that, I just wanted to open the floor for you and kind of go, is there anything that we haven't talked about in relation to M&A, exit transactions that is quite pressing and on your mind at the moment, or that people should know?
Look, one of the things that we are seeing, which is great, it had been. We talked about how there was a lot of activity in that 2020 to sort of end of 2021, beginning of 2022. It has been a quieter period of time. Transactions, there have been fewer transactions. Transactions have taken longer to get completed. In September last year, it felt like somebody suddenly flipped a switch. Okay. So one of the things I would say is the M&A market has definitely fired right back up. My team is probably busier than we've ever been with the level of activity going through. We are seeing levels of technology, commercial activity happening, which we haven't seen for a couple of years. And I do suspect that will spread to other parts of the economy. I know parts of it are struggling at the moment, but that's probably the sort of macro thing around it. But again, spinning back to the very first thing I said, if entrepreneurs could take one thing away, it's if that MBIO or that offer from a company hits the thing, your negotiating window starts as soon as that one comes down. And things like
I got it. And then get your great team around you, including a great M&A advisor. Yeah. Parting question for you, Mark. Definitely. The alternate universe, there's another Mark Clare that exists quite happily in that, but he's not an M&A advisor, he's not an investment banker, and he's got a great career. What would that career be?
I did think and look at some of the military side of things. And part of what intrigued me about that was the physical nature of it, which, again, I sit behind a desk and, drive some of the things there. I liked, the idea of being being out, being far more active than what I did there around it. And I did have friends that sort of went part way down the thing and did, some of the military side of things there.
Yeah, a similar rhetoric with different outcomes.
Yeah.
I remember hearing once that, the military contractor travelled to exotic locations and kill people.
Yeah.
The standing joke. Mark, it's been a fascinating conversation today. I thank you for both attending the show but also sharing much of your insight that you've garnered from doing hundreds of deals across the M&A space and this real kind of sweet spot that you've got around SaaS. I know that it'll be really well consumed by my audience, and so I'm really grateful for you coming on the show today, Mark. Thank you so much.
You're most welcome. It's been a fantastic conversation. Thank you.
If you enjoy these episodes, I hope you do. I love filming them, and the guests always say what a great and often cathartic experience it is for them. Then please do like and share. Hit me up on LinkedIn. I'm open to connect requests, and occasionally I get emails from people as well asking me about my experience around certain subjects. So please do like and share and continue to follow the show. I really appreciate your ears.